Savita Subramanian is Bank of America's head of U.S. equity and quantitative strategy, joins us live once again from New York. Nice to see you again, Savita.
Nice to see you, Scott.
So put the events of today into context about how you see the market.
Yeah, I mean, I think today's events are kind of, more of the same. There's a little bit of an overhang on the multiple of the S&P 500 on trade skirmishes, which I think is a good thing because it's keeping the S&P from getting too far ahead of itself. But you know what I think is interesting is if you look at this year, it's been a great year for stocks, but it's been all multiple expansion. We've seen basically flat earnings growth. So we went back over time and we said, okay, what happens in years after big multiple expansion, big upside for stocks, and you generally see a decent year for stocks, but it's all driven by earnings growth. So no multiple expansion, but reasonable earnings growth. And that's exactly what we're looking for next year is 8% earnings growth and kind of a 7 to 8% year for stocks. And I think that's a good environment in which to be an investor, especially relative to bonds and fixed income, where I think your returns are going to be pretty capped. So let's talk about trade, though. I think what's interesting is that this year, all these tariffs that have already gone through have actually been absorbed reasonably well by corporate America. I mean, companies in the U.S. have been gearing up and shifting supply chain out of China for the last decade or so. So this isn't all new for them. I think what we're seeing is the adaptability of corporate America. I do think if we do see the December 15 tariffs implemented, we could see a negative market reaction. So, our year-end target is roughly where we are right now. Not a lot more upside to stocks from here. In fact, more downside risk. Next year, we think is going to be a good year. But I totally agree with what Josh just said about going domestic within the U.S. and looking. Our favorite sectors are financials, consumer discretionary, and really looking for value opportunities and yield opportunities. And there's a lot of them right now. So that's really the framework we're thinking about.
I'm going to push you a little bit, though. 8% earnings growth. Yeah. How do you get that?
So I'll tell you how. It's not by some massive economic boom, but it's really the idea of easy comps. Because this year, it was tough to beat earnings growth last year. Because you remember last year, 2018, you had a massive earnings recovery, half of which was tax reform. So this year, flat earnings, it's really easy to move from flat earnings to reasonable earnings growth next year. I mean, if you look at bottom-up consensus, they're penciling in something like 11% earnings growth. We're getting 8% pretty easily. There's a little bit of margin compression in some sectors with more labor intensity or more cost pressure. But I think that as long as we avoid a recession, which it looks like we will, we're not using really strong assumptions to get to a decent year on earnings.
Yeah, but
year.
I mean, if you have no bottom in manufacturing, if you have global growth, which is still weak, and you have trade still out there.
Well, I think we're seeing a bottom in manufacturing right now. So I'll tell you something interesting. Our analysts have an industrial composite indicator where they aggregate all these sort of like canaries that they look at from a stock perspective, from surveys, and that inflected a month ago higher. And it's generally a very strong leading indicator for ISM, for business confidence, and all of these other kind of manufacturing barometers. So our early read on the manufacturing cycle is that we are inflecting higher in the very near term. Now, I think if we do see the December 15th tariffs go through, that could keep corporate America, kind of tamped down on spending money. And that's the big risk, is that if corporates say we're not going to spend anything on investment until we get an all clear on this tariff situation, that could be the big negative for growth. And that's something we're watching. But I find it very hard to imagine the president enacting tariffs that will hurt his voter base ahead of re-election. I just think that's a really hard scenario to argue for, given all of the sort of the calendar dates.
Why? He's already put tariffs into effect, which has hurt a lot of people. Why? What's going to change now?
Well, the tariffs that have been put into place, like I said, have been generally relatively well absorbed by corporates. They've also subsidized farming in areas that were really hurt. But I think if you slap a consumer tax or a consumer goods tax onto goods come December 15th, and we start to see some pain from his voting base, that will be reversed quickly. I don't see that as a scenario that's likely to be enacted ahead of the re-election.
Hey, Savita, it's Josh. I wouldn't be surprised if he put in. So I'm on the other side of you. I think there's nothing that he wouldn't do or couldn't do, no matter how little sense it might make. He just tweeted a picture of himself on top of Sylvester Stallone's body. Like, what are we? We're through the looking glass already. Let's pivot though. Last week, the Russell 2000, which I've argued was the last piece of the puzzle for a truly breadth-driven, sustained new bull market after, I don't know, almost 2 years of consolidation. You finally got the Russell to break out. And then, of course, this happens 2 days later. What are we to make of breadth, internals, flows to small caps? I know you track this stuff really closely. We don't talk about this stuff enough, in my opinion.
Yeah, so it's interesting because you are seeing flows a very sustained trend of flows coming out of the winners and moving into the losers, which is why I think we could see a nice value-driven market, which is something we haven't seen in a very, very long time. Let me tell you guys something that might not be immediately apparent. If you look at the holdings of mutual funds, hedge funds, like basically every investor class out there on the institutional side, they are all glommed onto the same stuff. It's all the growth stocks, all the momentum stocks that have worked for, multiple years. And I think the risk is that those stocks are already crowded. They're already expensive. You're starting to hear smatterings of, regulatory risk against tech companies. We just downgraded tech from an overweight to an equal weight. It's done great this year, but I think its run is over because you're now at a point where it's super crowded. There's all this friction around China versus U.S. tech, supply chain disruption, and you've got bipartisan support to regulate tech companies. So I think a lot of this momentum, leadership is really threatened by the current environment, both from a crowding perspective as well as from a regulatory and policy perspective. That's one trade that I would exit out of at this point.
All right, Savita, we appreciate it.
I would move out of tech.
Nope, finish your thought.
Sure, my pleasure.
Finish quick. Finish quick.
Oh, no. That's okay. I think the last bit I want to say is one of the other reasons I like value is I think U.S. financials is slated to do really well this year. It's a high-quality sector. It's well-capitalized. It's paying a dividend that's well above the market. I mean, these are the stocks you want to own for the next 12 months.
We appreciate it. Forgive me for talking over you there at the end. It's nice to have you back. We'll see you again soon.
Thanks a lot.
That's Savita Subramanian.